Okay, so we're looking at the S&P 500, and as you can see, we are actually at a support level right now. We're basically at a moving average. Let me see, what moving average are we at? We're near the 50-day moving average. Okay, so each one of these moving averages, there's 50-day, 100-day, 200-day, etc. And each one of these is kind of a buffer area for the stock market, the S&P, because there's a lot of algorithms that assume that a index will go down to a moving average and kind of hold there until it loses support. Right now, we have this uptrend that's been going on since last October, and it's a well-defined channel, and with the tops and the bottoms pretty well defined. We're at the bottom of the channel, and we're super oversold now. What's interesting about today's action in the stock market is that we had, let's do a one-day chart. Okay, if you look at the, we start off the day lower, and we're kind of coming back in the stock market. So you can take from that, maybe we have some support here, and everyone else in the stock market's looking at these same support levels. So it very well may be that we have what's called an outside reversal today. An outside reversal is whenever it drops low and it closes higher, and that's just an indication we have a change in direction in the stock market. So we're oversold. We're down to 10 in the stochastics. That is really, really low. And we're at the bottom of the channel. So there's a good chance we'll be bouncing. We have a couple catalysts that are coming up in the next week. Okay, this is August. We assume that this is one of the worst months of the year, and September is one of the worst months of the year, seasonality-wise. And let's see. Okay. The next week, we have NVIDIA earnings coming out on the 23rd. And they already pre-announced that they would have better earnings than expected. And there's a good chance that because NVIDIA's run up until this time, we buy in the rumor and sell in the news. I don't know. But that's going to be a catalyst for all the AI stocks that have been going up recently. The 25th, we have a statement from the Fed, and that could give an indication of interest rates going up or down. So those are the two big events. Right? We don't have after this, the earnings are over, and we have to wait for at least until October for earnings again. So that's why the people are going on vacation now. There's lower volume, so that's kind of the reasons why we don't expect the stock market to be going up these 2 months. All right. So we had a Fitch downgrade of U.S. debt a week ago or 2 weeks ago. And what's been happening, I'm not sure if this is related to that, but the U.S. Treasuries, they're going up, and that's what's making the stock market skittish right now. Because you have to balance the risk that you take in investing in stocks with guaranteed returns from the U.S. Treasury. And the higher these rates go for the 10-year and the 2-year, the worse it is for stocks. So I think it's up 2.2% because because Fitch downgraded the U.S. debt. That makes less people will have to pay more. I mean, the United States will have to pay more in interest to get people interested in buying that because there's more risk of a default. So that isn't good. As these Treasury yields go up, so does the stock market go down. That's what the pattern is. Okay, so we already said that these two things are happening next week. Next thing is we're losing momentum. Every week we're going down a lot in momentum. So we have this in our meeting notes. We have these two um, links that go to the S&P above the 50-day moving average percentage of stocks. So now it was 56. Now it's 33. So we're definitely losing momentum. I don't know if we're going to break out of this channel we're in, the great channel we've been in all year long in the S&P or not. But as this goes down, the chances of us continuing to go up or going down. We like to have it, we like to have this at like 60 or 70%. Then whenever we have that full market participation, then then we have a lot of momentum and the stocks just go up and they drift up. So that's not helping out. And right now we also have the U.S. dollar is strengthening. So that's a headwind for stocks. That's bad for stocks. Especially for stocks that are active overseas. So let me see what else is happening here. All right, let's look at seasonality. We're still in the two worst months of the year, so we're expecting not good things. And seasonality, again, we're not expecting much out of these 2 months. We just went over the S&P 500. We are at the bottom of the channel, and stochastics are super oversold. I think the Fitch downgrade from 2 weeks ago, if that makes the treasuries go up higher and higher every week, that could be the main thing that people say will make the stock market go down. That could be a huge catalyst for tech stocks, anything high multiple to correct. But people aren't talking about that anymore, but that's, I just see that connection, but no one else is talking about that. All right, let's look at, let's see. We haven't had a whole lot of change in, anyone have to say anything to say? Okay. Oil is down a couple dollars a barrel. It's not that much. Let me see. Inflation is currently 3.2%. Dollar index is up a little bit, 1% this week, and gold is down. Okay, so that doesn't really go. I'm sorry.
Sorry, one thing on the inflation number, I hear like news stories saying that one of the components is like housing or rental, and that's like a lag. It's not real time data. It's like months old. Do you know anything about this?
Yes, that's what we were saying last week. The Fed. This is Jeremy Siegel. He's like a Wharton professor, and he always gives his opinion on things on CNBC. Jeremy Siegel says the data that the government uses for housing is stale, and if you use current data, that's like active. Maybe you look at the housing prices in the newspaper or something like that. That is whenever you factor that in, there's zero inflation. That's what Jeremy Siegel said, and also there's a guy from Starwood, a company that actually rents places out, as part of their business. And they said that rent prices are dropping like a rock, and that will not be a problem. And so you have a couple people that, that I've noticed on CNBC saying that. So that's why I was thinking it's, this inflation, there's a lot of people in the Fed right now that are saying this inflation is going to be sticky. We're going to stay higher for longer, and that banter from these Fed officials is making the rates for the United States Treasury bonds go up in a way too. So I don't know. It's amazing. When we first started, this meeting, we didn't really focus on interest rates, but it is a huge portion of the math involved with what do you pay for stocks. It's all related to what is what do you get in a non-risk return instrument like a U.S. Treasury. So if the U.S. Treasury paid 10% yield, who's going to want to invest in stocks? So it's like that. The higher the Treasury goes in yield, the less appetite people have for stocks. So there's a formula there somewhere. If you have like a 6% yield or a 7% yield, then in the U.S. Treasury, then you pay X percent less for the S&P 500 in a multiple. So we figured that out.
And I assume, companies that have to borrow, so companies that have cash, it's I guess they're getting better return on their cash. But if you're a company that's borrowing, then presumably you're having to pay more interest on your bonds, and that'll drag on earnings too. Seems like there's kind of a double whammy there.
Yes. So it seems like every crisis that we've experienced as investors and around the world, the major crises in the world revolve around debt and borrowing money and getting over leveraged. So it's a big part of doing business. You borrow money, you can buy companies, you can grow and expand your business, but you got to pay off. That whenever you borrow money, you got to pay interest and all that, and that also reduces the amount that you make. So that whole borrowing money is it's like half of investing. You got to really understand, the debt market. Most companies need to borrow money. Most companies, even IBM, has issues bonds. Even though they have a great credit rating, they still, and Apple borrows at a max because they know they can borrow for a small amount. 2 years ago, they got some companies and people to buy their debt for less than 1%, interest for 10 years. So they borrowed money almost free for 10 years, but now the other companies are kind of scrambling and trying to borrow money, and it's getting more and more expensive. So I guess So that's the importance of that debt part of the statistic over a company. Looking at how much debt they have compared to their market cap is super important, because that's one thing that could bring a company down and make them go bankrupt or make them be an underperforming company. And that's why Warren Buffett likes to have, buy companies that have large amount of free cash flow, large amount of not a whole lot of debt, and I don't know. Debt is a very important part of business, but I don't know. Does that answer your question, Matthew?
I think so. Yeah.
Oh, all right. All right. So let me see. Okay, so we've been gradually going from extreme greed 4 weeks ago to greed 3 weeks ago. Now we're neutral. We're drifting towards fear, and the pretty soon will be extreme fear. This is the time of the year. September, October have been some of the biggest crashes in the history of the stock market. So people naturally get fearful when that time comes again, and there's no real catalyst for stocks to go up right now. There's only Fed news. There's government reports that come out for the economy, and it's really no real catalysts that are good that could break us out of this. That's why we're going towards fear. And my guess is next week or 2 weeks from now we'll be at extreme fear. So this is the time to buy, and whenever it's extreme greed, you don't buy. Let's see the dollar index. It's actually breaking out a little bit. I mean, we had this established downtrend for a while, and all of a sudden we see just a little bit of dollar appreciating this week. So I don't know if that's a trend. Maybe we'll continue our downward dollar. But if this ends up going higher and we have the dollar appreciating, then that'll be a hit to a lot of the multinational companies' earnings. So I'm rooting for this to go down there down to here. We'll see. The VIX is going up. It's up 13% since last week. So as people get more fearful, the VIX goes up with that. So
yeah, it seemed crazy that it was so low.
Yeah, it was low.
Sense that it's going up.
Well, we had a mania, and we had people excited, fear missing out, right? And they don't buy protection. Now it's the opposite.
So the VIX is it directly related to trades on futures or options? What is it?
I'm not sure, but I think it's a number that is I think CME Group comes up with this number. It's basically, if you see how many puts are active number of puts versus active number of calls, and if you do that math and see if there's more people fearful and they're protecting their positions with puts, maybe that's why they call it the fear index. I'm not sure exactly how they come up with this.
Yeah, I think you're right, though. It's related to the pricing of certain options, right? There's some calculation they're doing for option trading that's happening. Okay, that's good to know.
So I guess if you had, there's like the Black-Scholes algorithm for options. If you have like a super high premium for puts, like people are thinking if the stock market's going down, I better protect myself. Then you have to pay more for that protection. And I guess there's a mathematical formula. You can say, well, people aren't buying calls because they're really cheap right now, but they're buying puts, so the puts are more expensive. Maybe it's involving something like that. I'm not sure. But it's just for us, it's a contrary indicator. It's an indication that people are starting to get fearful, and Warren Buffett would see it as, whenever the VIX gets up to 30, that's the time to buy. Whenever it's down to 10 or 15, like it's been for a while now, it's not time to buy. All right, so I was looking at this emotional chart. I'm thinking we're gearing towards fear. We were up here for a while with our AI, all the AI stocks, and fear of missing out. We were in an uptrend. You couldn't go wrong. And right now we had that Fitch downgrade, and now I have all these things that could derail the market listed here. Chinese real estate crisis. This is starting to come up. I'd say maybe 10 or 15%, maybe 20% of some of the growth for the stock market, for stocks like Apple or Nike, come from China. Rats. Come from China. So if you have any hiccups in China, or if China sneezes, the whole world will catch the cold, right? So there was an article that came out on CNBC about, here it is, China's property giant Evergrande files for bankruptcy protection. So there's a huge debt problem in China where they're lending out a lot of money to grow, and then now this is their default starting to happen. And if China has a problem, you have to figure out how much each of the stocks that you own are involved in China, and then you have to figure, well, if China's not going to be, they have a problem with the debt market or something, and they're not going to be growing as fast, then people aren't going to be buying iPhones as much. They're not going to, etc. So that could make a lot of the stocks involved in China go down, and that could make the whole stock market go down. So this is one thing that could be a problem, like a black swan event. I don't know. So that's one thing. China real estate crisis. Fitch downgrade, that could be a reason the stock market could tank. NVIDIA earnings disappointment. So if they disappoint or don't guide for good earnings, that crashes, all the AI stocks go down with it. Consumer debt right now is at all-time high. So if you have a lot of if people are maxing out their credit cards, they're not going to be able to spend, and that hurts the economy. That store right there could be a problem. There's a lot more bankruptcies now than before. And of course, Matthew said that commercial real estate defaults could be happening. So these are all things that could be the next thing to make the stock market go down. We don't know. But for me, I'm just buying and holding and knowing that, it could be a rough time in the next couple months. And on top of all this, rising yields in the U.S. Treasury and rising rates from the Fed, those are always things that will make the stock market go down. Okay. This is one of my favorite times of the year. Every quarter, they list all of the there are filings that every mutual fund and money manager that manages like maybe 200 billion or more, they have to list all their top holdings for the mutual funds, for the hedge funds. And this is the time you get to see and compare what was added and removed from mutual funds, and that are some of the best mutual funds. So what I did was every quarter I do this. We compare what was in February to what we have right now. And okay, so I noticed T. Rowe Price. Well, I got a mutual fund from every different type of just different major companies. One is T. Rowe Price. They got rid of Amazon, Alibaba, Tencent, and PayPal, and they got Microsoft, Apple, Nvidia, United Health, and Tesla. So we noticed last time we did this, a quarter ago, people were starting to buy a lot of Nvidia, and at the time it didn't make any. It raised some eyebrows, but it was only a couple of them that were loading up on it. But it's probably one of the best performing stocks this year in the stock market. So it's really useful to actually watch this. And if you find one in here that you're not following, this is the time to actually do some research and see if it makes sense for you. For Fidelity Magellan, I was surprised at the number of changes they made. They don't make changes very often, and they totally redid the whole profile, basically. They left Microsoft, United Health, and Eli Lilly, and they basically totally redid the whole other 7 holdings in the top 10. That was great. And why would they do that? I mean, Magellan is known for buying and holding and not selling. You can see they have Visa and MasterCard. Visa and MasterCard, which are monopolies, basically. Costco, Lind PLC. Lind PLC is they make gas products, like hydrogen, and I think that's one of their biggest growth parts of their business for the green energy. So Broadcom and S&P Global. I'm surprised. I mean, they've kept their portfolio basically the same, and now they're getting out of some of the big tech stocks, which is very surprising to me. Does anyone have any idea?
Yeah, the T. Rowe Price blue chip growth loaded up on Apple, which I think is interesting because I don't feel like a lot of people are bullish on Apple right now at the current price.
Yeah, look at this. Yeah. They had 4% and they doubled. I mean, this is super dangerous. That's 14% in Microsoft, right? I mean, that's pretty reckless.
I own Microsoft and Apple, and I'm like, oh, it's interesting that they're dumping money into Apple. I guess, in some ways, I understand. I think Microsoft has some AI type stuff that you can try to get in on. This just seems like some sort of weird. Yeah, I don't know what they're doing.
Yeah, well, I think the reason I like Microsoft, I've owned it for 15 years or something. I like Microsoft because they have a monopoly and no one's doing anything about it, and then they have all these other. Once they have that monopoly, they can sell you OneDrive, they can sell you the cloud, and they have different means of making money. They have the gaming, they have the cloud, they have Windows and Office, they have Well, anyway, it's very diversified,
and I think they also have good leadership now. If you owned, I think that the indictment against Ballmer is that he ran Microsoft for like 10 years or whatever, however long it was, and it did nothing. It went stock. And as soon as he was gone, the stock just like took off, and they have a much better engineering culture. I think that their leadership, their CEO is Sindir. What's his name?
I forget.
But yeah, I think it was obvious to customers, and it was obvious to the financial side of the company that the leadership was a problem at Microsoft, and now they have good leadership. So
Yeah. I think one more thing about Microsoft is it's probably one of the only AAA rated companies. I mean, they can borrow money almost free because they have like an AA rating. So they don't have to borrow money, and they have a huge cash flow, and they're buying companies regularly to grow. And I thought that's a pretty good combination.
Yeah, and they'll have failures, but they've also had big successes, and they can build things themselves. So yeah, they both acquire and they do internal development. It's not they don't just acquire, and they have a track record of both good acquisitions and the ability to build their own internally. So yeah, I think Microsoft compared to let me think here, 10 years ago, yeah. So you look at Microsoft in 2013, 2013. Microsoft's it's gone up a lot, but I think it's for good reason. I think it's been well run for the last 10 years.
Yeah, I think lately they've been given a good multiple, meaning people pay more for it because they have this AI kicker where they're charging $15 a month per seat for an AI co-pilot. That is, if they get any traction with that, just imagine 15, and they have 200 million users, and if they get a small portion of those using this AI pilot, co-pilot. So Microsoft, yeah, they didn't do anything for a while, but the reason I owned it is I saw they had a high return on equity, and they had a large, the high cash flow and free cash flow. But having 14,
you noticed that Magellan kept it, right? Magellan kept Microsoft when they sold Apple, Amazon, Google, Facebook, Meta.
Yeah, that's interesting, and they're keeping Eli Lilly too. That's interesting. That and they sold off on all the big tech stocks.
Yeah, Eli Lilly was the one that you told me about, and then it took off. So
yeah.
I'm not sure where it's going. It seems very expensive.
I started my position like really small, and I just as the news came out that it's becoming obvious that they're going to have two blockbuster drugs potentially, and I don't know. I followed the earnings estimates, and they were like 30% a year regularly in the next couple of years, and for a drug stock, that's pretty unheard of, I think. So.
And Magellan's getting in on the Costco purchases. That's great. That's good for me. I have a lot of Costco. So.
Oh yeah, So Costco's the great thing about Costco is they make most of their money on the dues. What do you call those things? Dues.
The membership. Yeah.
Membership fees.
Yeah.
So they'll give their chicken, whatever they sell their chickens away. They sell whole chickens. And that's
chickens.
Yeah, rotisserie. Okay, so we see that they're taking a huge bet in Apple and Microsoft right now. That's very dangerous for a mutual fund. There are some mutual funds that have made some big bets in banks like Washington Mutual, like maybe 20% in Washington Mutual, and then it went bankrupt, and they looked really bad. But I guess they have a lot of confidence in that. And let's look at. I'm sorry. Go ahead.
Tesla's interesting here on the T Rowe price. So the new news in Tesla is that their charging system, they've actually finally opened it up really, and they are now become the North American standard. Ford is going to be using them. I think that all the North American cars are going to be using the Tesla charging port here.
Right, but there are the existing charging stations. They said they would adapt that standard. What percentage percentage do they get from Tesla? What does Tesla get from that? I'm not sure about that.
I don't know, but the other companies' cars are going to use Tesla's chargers. It's not. I don't think it's the third-party chargers that I'm interested in. It's if Ford and if you're driving a Ford or you're driving a Toyota or something. Well, I guess Toyota's kind of out of the EV game for a little bit, but that you can now use the Tesla chargers, which you couldn't before.
Yeah, that's pretty big.
You'll have the same plug, and so that their charging network, not only is it bigger right now, I think, than almost anyone else, but I think they're about to get a lot more customers to that, to their chargers. Which will give them a network effect that'll they'll be able to build more and get more, and I think it'll be that's the big thing with Tesla right now.
I think that I expected to see that in the earnings estimates. Hold on, I gotta sign in again. I expected that to be in the earnings estimates, but I didn't. The earnings estimates haven't been going up for Tesla. I mean, if they're selling, they're going to be an energy company, but they should have those estimates in the future for making money with that. But it doesn't seem like they're going to make any money with that based on their estimates here.
Yeah. But you can imagine if they become kind of a standard kind of, they start replacing gas stations. It's a part of their business I never really thought about. It could be significant.
That's not like being an ExxonMobil of the new cars.
Yeah.
It's like, look at that.
Because it's one thing to be a car company. It's another thing to be a car charging company and people be paying you to charge all their cars.
I think it's it could be considered a razor blade model, because Tesla could be giving away their cars now so they can make money on charging. That's a lot like how Apple subsidizes some iPhones so that they could charge for services, revenue for their. So it's 30% they're growing, 4.7. Like 5.9.
I was watching some stuff about someone who has a non-Tesla car, and they're talking about how they don't necessarily love the Tesla charging system, but the other options are worse. Like that the third-party chargers are just terrible, and that Tesla, that Tesla feels like an Apple type product where if this guy's kind of geeky and engineering type, but he had to admit that like their charging stations are better than. Using them as a better customer experience than like the third-party ones.
Yeah, that's probably good on their side too. Okay, here's some more mutual funds. Sequoia Fund. Okay, so they basically added Google. They added Constellation Software at Intercontinental Exchange. That's New York Stock Exchange, and they got rid of Facebook and a couple other no-name companies. No, actually they didn't. They kept Google. Google used to be a different symbol, so I'm sorry, that was wrong. But they added, what did they add? They kept Charles Schwab. That was one of those stocks that we were saying is a little bit undervalued. T. Rowe Price, they totally redid the whole portfolio. I mean, everything has changed. They added Apple, Microsoft again, 11%. Wow. Can you believe that? And NVIDIA and
TSMC. Interesting.
That's interesting that they would make. I guess whenever this is from February until now, I'm just surprised that they would totally redo this. Maybe it's because some of these stocks they had before were high multiple stocks like Amazon, Netflix.
This is the global. It's a tech fund. It is a tech fund specifically.
Yeah, T. Rowe Price Global Tech Fund. Right. They could choose anywhere in the world to buy things, and they chose Apple, Microsoft, and NVIDIA as the top 30% of the portfolio. That's amazing. And before they had Alibaba, CRM, that's Salesforce, and Amazon. They totally redid that. That's amazing. So this company,
8% of Baba. Oof.
well, it was the China companies. Alibaba is actually. I was looking at that stock recently. Alibaba is actually becoming a value stock. Let's look at the earnings. I think it has a P of around 10. Let's look. And it's growing more than that. So it's a P 20. Oh, I thought I was wrong. P of 20.
There's so much political risk. Like,
it's
China
too
risk.
much.
Like, yeah.
It looks like it's growing 10%, 10-15% a year there. I mean, it's in a straight line up. But the China government can find them at any point in time, and they'll lose all the profits, and that's not fair. So it's good watching it. It's kind of out of scope for what we're doing here.
Speaking of that, it's interesting. So I don't know if you've paid attention to, we're talking about Tesla, BYD, I think it is, the Chinese car maker.
Yeah, Warren Buffett invested in that company.
He's slowly selling off that position. So they got an early investment. It was a battery company, and he got a pretty early position in as a car company, and they made a lot. He made a lot on that, billions, like 9 or something billion. And they are slowly selling that off, which I think makes sense. But it's a pretty slow going. But I think that that was a good trade for them, and they're getting out of it. It doesn't it makes sense to get out of it. I think they just not think it has.
It's interesting that Warren Buffett and Charlie Munger don't shy away from foreign investments. I mean, they must really know their stuff to be able to invest in different countries. Like they bought Japanese trading firms, that Warren Buffett did, and then Charlie Munger, he was in the Alibaba as like a 15% of the portfolio for one of the funds he was managing. But Alibaba, since that he started investing a lot, turned into be a really good performer. So
and I think the lesson from Tesla and BYD is that you've got to be making your own batteries. Tesla, early on partnered with Philips, I think it was, on their batteries, and BYD was a battery company. And now I think the big car automakers who are wanting to get into EVs more are taking a much stronger look at sourcing, being involved in the battery production. You can't just make the car. I think you've got to be involved in the battery.
Yeah, I think that's what Tesla did. Tesla made these huge contracts with the cobalt companies that no one else is doing. They make the gigafactories, and now Ford's relying on Panasonic and other companies to make batteries for them or whatever. But I think that was a good approach.
Yeah. So Tesla had a strategic partnership where they were like building the factories together. And that was actually when I did own. I don't own Tesla anymore, but when I got into Tesla, that was part of when I was why I was buying in. Was seeing like that they were doing this battery. It seemed like they're doing battery correctly. But yeah, I got a Tesla a long time ago, unfortunately, because I thought it was overvalued and it kept going up. So
well, it's still overvalued, but
So that's why I haven't gotten back in.
So I guess even we know the big tech stocks are overvalued now, but you see that T. Rowe Price, they're loading up on it. Sequoia Fund is, and this Oakmark, they're famous for being value investors. This Nygren guy that runs it, he's like a super value investor, and it's interesting. He chose to totally redo the whole portfolio. This company they've been known for investing in a lot of banks before. Like whenever the financial crisis hit, he was buying up banks, this guy. And look at all these banks that he had in his portfolio in February. And then we had that banking crisis. He unloaded all the banks that he was. I mean, that's most of the profile of his holdings were banks. Then he got into, let me see. Well, I don't know. I guess his big bet on banks were kind of bad because he had like 25% of his whole fund in banking companies. And that's an example of it's super dangerous to load all of your portfolio in one sector. I'm doing that now because I just have I'm managing big positions that have accumulated over time, but whenever you're managing someone else's money, you really have to make sure you don't overweight. If you're just a value fund, you shouldn't overweight one sector. So that was good.
Yeah, I wonder what Alphabet. It seems like Apple quite a few years ago, they made the change and started paying the dividends. I wonder what Alphabet's leadership, why they're not looking at dividends. It seems like they should at some point start doing dividends at this point.
Whenever
I just don't feel like I feel like they just don't have places to put money.
I think Warren Buffett kind of says, if I thought that was the best way to deploy capital, he would do it. He would give it back to the shareholders. But Warren Buffett thinks that buying companies adds more value than giving that money back to the customer.
And he's earned that. He's earned that.
Yeah.
I don't believe Alphabet is as good at deploying money as they would be as if they start returning it. So.
And they say that a tech stock turns into a value stock whenever you start giving a dividend because you stopped your growth. You don't put all of your cash flow into growth opportunities. You stop that growth, and then I guess it's considered a totally different stock when you pay a dividend because you're not growing anymore. You're just giving all your profits to your shareholders.
Microsoft and Apple have figured out how to do both. So.
Yeah, absolutely. And Microsoft.
I think Google could do both. I think it would bring some discipline to Google's management. I think that their management doesn't have discipline right now.
They are buying stock back though. I mean, this Ruth Horhat person who was the COO for a while, she recently quit, but she was like trying to allocate that capital. They're sitting on a lot of money, like $50 billion right now that they can of cash, and they have a lot of cash flow.
How much is their stock buying relative to employee compensation? My question for Google.
Oh, I don't know. What's interesting about employee compensation? Some of the options aren't even, the things they give their employees aren't even figured out in the balance sheet. Like if you give out, and that's weird. I don't know how they do that. How you get away with them.
And so because some tech companies, they're buying stock, but then that's because they have to be giving it to employees, and so it's part of their compensation. So even though they're doing stock buybacks, the share count isn't going down. What the Google share count is. And so I don't know what Google's doing, but just because they're buying shares doesn't mean that they're not giving them away somewhere.
Yeah, perhaps. So I think what happened with this Oakmark funds is this guy realized he screwed up, because all the banks were going down, and he didn't want to be caught with all the banks in his holdings at the end of the quarter. And then he started investing in more conservative things like oil, and he got more diversified with this. But you learn a lot when you're looking at the changes that companies make that are portfolios. Another thing that happens is every quarter is Berkshire Hathaway comes out with all the additions and subtractions of their stocks that they have. And I was interested to see that they have a couple of the stocks that we were going over last year as value stocks. And I'm not tooting my own horn, but I found these before Warren Buffett. And we were going over, the fair value of these stocks were lower than what they were selling for. And last year, last June, we were saying their fair value is, they're selling at a discount. The catalyst was there's a low inventory on housing. And we didn't think last year at the time that higher interest rates would prevent people from moving, because if you sell your house, then you'd have to get a mortgage at 7%, and no one wants to do that. So there's a low inventory now of houses, and that's making a demand for new houses greater. So we didn't think about that part, but we knew the interest rates should be done rising at the end of last year. That was our estimate. I'm going to go over just what we were thinking last year. This is Lennar. We were thinking about that stock as an opportunity down here in June of last year. And let's look at, and Warren Buffett ended up buying it. So I'm like, wow, we must have a formula that might be pretty darn good if Warren Buffett looks at it too. So Warren Buffett actually bought D.R. Horton and Lennar. This is from our 6/10/22 meeting. There was an article on CNBC Pro that says undervalued stocks. There's a couple undervalued stocks, Ford, Lennar, and D.R. Horton. I cut Ford out because I wanted to focus on what Warren Buffett bought. And we were saying at the time that the PEG ratio was, was on sale, like 15% undervalued for Lennar and 33%? No. Yeah, 33% undervalued for D.R. Horton. Just looking at the PEG ratio. And look at their PEs were like 4 and 4, and 4. So I guess the lesson we learned here was these home building stocks were being thrown out with the bathwater because rising interest rates will slow the demand for buying houses. That was the reason why all these were down in a major way. And let's look at some of the fair values.
I think that's worth focusing on here is the thing that I've been able to, I feel like, do as a trader is to see one of these macro trends, right? Where there's some macro event that then reflects on a lot of companies. And there's so their stocks all go down. So you get a bunch of companies which stocks are down for some macro event. And if you can identify companies in that list that are exceptions, so some of those it's legitimate, right? That they are down for a good reason. But I think that the thing that happens is that we get the sector, kind of the whole sector is down. There are companies which aren't as affected as much, that for some reason that company is being punished, the stock price is being sold, but the macro trend is not actually bad, that bad for that company or something, right? That's a time when I think that's a time to find undervalued stocks.
Right.
Because it's hard when there's like I feel like I have a hard time when there's economy wide there's something's affecting everything, right? To identify this company really isn't that bad, but if there's a sector pullback, you can say no, these are good companies in that sector, and this is really not going to impact them the same way it is other companies. That those can be a good buy, and that's something I think an individual investor can actually pick up on.
Yeah. The idea that there's always news coming out about stocks, you have to say, is that good for it, bad for it, or no op, or neutral? It doesn't have any effect. So you have to determine that at all times. Even right now, we know rising interest rates is bad for all stocks.
Yeah.
Because it costs more to borrow money, and even if you're Apple that doesn't need to borrow money, the companies and people that have these high interest rate credit cards aren't going to be able to buy iPhones. So you do have a little bit of effect on this rising interest rate story, just like we had last year when this housing that we're having problems. So and
then the hard part then, so first of all I described is once if the market recognizes the next earnings or two that you've made the correct decision, this company really isn't as bad a shape as they thought, it's when to get out, I think, is the real trick then if you're looking to do value investing.
Yeah, for me it's kind of hard buying home builders. I'm not really I don't understand the industry that well. It's when we're in a tech world here, so we know tech pretty good. We know Google, we use it every day. We know Apple because we have iPhones. But I guess the home builder is a little bit different of a world, because you deal with interest rates, you deal with people, the fickle people buying houses, and the number of people that are renting versus owning. I don't know. It's complicated, but I'm going to go over a little bit more about what we saw a year ago that was interesting.
Yeah. No, I'm interested in this. And then, so you said that you did get into D.R. Horton?
I did not. I didn't have a confidence level. I just said this is an example of a stock that's undervalued, and it looks like it's out of favor, but it shouldn't be thrown out with the bathwater, right?
Yeah. Yeah. And so I think that those are really interesting. And I think it's a place an individual investor can make money. And then I think the trick that I don't think I have a good handle on is once that it's not out of favor, how do you know when to sell it then? Because you're not in it for the long term. You're in it because it's undervalued. And then how do you have to figure out that it's fairly valued again and get out?
Yeah, the way I do that is I go to E-Trade and I look at the chart here. This is it continuing to grow? And I looked at Lennar. It wasn't that exciting. It's growing like maybe 8 to 10%. So I'm going to go over that right now. But hold on for a second.
Okay, thanks.
Hold on, it's going to be good. It's going to be good. Hold on. It's here somewhere. Hold on. Rats. Let's go over it here. Okay, Lennar. Let's look at the earnings. So its PE is 8 right now, and that's definitely going up in a straight line. It had a 2022 to 23. There was a negative 30% or something like that. Let's see if it's actually still growing. This is the way I would normally sell a stock. If I see it's like flat, like Verizon right now, it's flat. I'm like, and they're losing customers. Let's look at this. 12.61 divided by 13.57. That's 7%. 13.57 divided by 14.85. 9%. 14.85 divided by 1. 13%. So they're growing around 10%, and their P is 8. So they're like undervalued by 10 or 15%. So, but that's, I guess Warren Buffett would like it that it's pretty consistent, earnings over time. And Warren Buffett really likes, he believes in the U.S. economy. He says it's like it's a freight train. It keeps growing. The number of people in America keep growing, and the amount of economic activity grows over time. And that's why I guess he thinks there's going to be more houses and more people buying houses over time. And it's a simple business for him too, because he buys things he understands, and this is kind of an easy thing to get your mind around. Just you build houses and you buy property, and I don't know. Okay, so let's look at. Okay, so this is the notes. We saw that the fair value estimate was 113, and it was trading at. Let me see. The fair value was 2. This is for DHI, and they're like 40% undervalued last year. Lennar, its fair value was $205, and they were trading at 75 at the time. So they were at 40% undervalued. So I guess Warren Buffett was looking at the same numbers and said, hey, that this is an industry that's going to have, in 20 years, we're going to have more houses built than now with the growing economy, and it's a steady company that he understands. So I'm just trying to understand that. We also did from last year, we did KB Homes. They had an article, they beat on second quarter earnings, and we had this thesis at the time. Their revenue was up by 20%. So we said the home stock's currently out of favor. They're still low on inventory. I mean, in St. Louis, when we were way back when, we were saying it's really hard to buy a house now because not a lot of houses were on the market. So that was a good reason to buy a new house. So there's still a high demand for houses at that time. And what the one problem was, they didn't have any forward guidance. So I wonder if they've updated that. This was last year. Let's look at KB Homes and see if they're actually growing at all now. KBH. That was one of the reasons why I was afraid to look into this, because there wasn't any analysts really saying they were going to grow. Let's look at the KBH. Let's look at the earnings now. They have a PE of 5. That is super low. And let's look at their 6.41 divided by 7.02. 9% growth. 7.02 divided by 7.65. 9%. So they're growing at 9%. They have a PE of 8 or 9. So that's a PEG ratio of 1. That means they're fairly valued, but they're not growing a whole lot. That's only 9%. But that's a consistent 9%. They didn't have these numbers last year when we were doing our math. They only had, they were going to lose money from, their earnings would go down year over year. So let's look at $10 a share, 2020. KBR. Yep. So that we didn't have the information we needed. If there was a straight line up, I would have bought this, but everyone was uncertain about the future of the company back then. Okay, so let me see. So at the time, we also had a PEG ratio. What was non-existent. That was kind of weird. All right. Okay, so here's what they said in this article of Yahoo Finance. They said the implications are twofold. Existing homeowners stay put and sit on their historically low mortgage versus sell their house and own a new home with a much higher mortgage. So that's a reason for people to keep their houses and not upgrade to a new one. And the inventory of available homes for sale shrinks, and the total cost of ownership closes off many Americans from owning a house. So anyway, this was an interesting exercise, but I always like to see Warren Buffett looking at an investment I've been like eyeing up, even if I don't buy it. But I bought Apple 5 years before Warren Buffett did, so that I'm proud of that. Let me see. So look at this. The mortgage rates continue to rise. It's 7%. That's what it was in 2002. Yeah, 2002. It hasn't been this high since 2002. So, anyways, I wanted to bring up a couple more things. There's breaks in trend. Whenever we're following these charts, we're doing it down to like the penny. We watch this chart. We watch like S&P right now is at the low end of their chart, like right here. If S&P starts breaking, the trend like these stocks are, then there's a very good chance that we're going to start a new trend downward or out of this uptrend. So right now, Microsoft broke out of this uptrend. Let's look at other ones. See, the VIX was in a downtrend for a while. Now all of a sudden it turned up recently up to 18 from 15. The other things, PepsiCo, it was on this uptrend for multiple years, and now it's just starting to break down. And the dollar index again is just starting to break out of this downtrend. Let me see. Okay, what I did was I followed up the Lennar research we did last year with research this year. It says their PE is still 9. That's really low. And the profit margin is 12, and return on equity is 18. That's all really good. That's probably why Warren Buffett was interested in it. He likes to look at these. And I looked at the Lennar's growth, and they said that they're growing around 9% a year. The PE is 8, so the PEG ratio is around fair value or 12% undervalued, one of the two. CFRA said they're undervalued by 37% still, and the Morningstar says they're absolutely fair valued. They're trading at what their fair value is. So that was a good follow-up to something we looked at last year. The other things I wanted to bring up are Kathy Woods had some disasters in her portfolio. There's some Roblox, Square, and Coinbase that went down a lot. And she puts these big bets on speculative stocks in her ARK portfolio. And so now the best performing mutual funds are these ones here. And I'm going to go over just the top holdings on each of these, just a couple of them. So this Fidelity Blue Chip Growth. The top holdings are Apple, NVIDIA, Microsoft, Amazon, Google, Meta, just the top highest market cap stocks, basically. And the Harbor Long-Term Growth Investors ETF, the other one that has a really good performance this year, has the same stocks, basically. So, and we see Eli Lilly again in the growth stocks. So, whenever a lot of mutual funds have the same stocks, it's a very good indication it might be a good stock for a buy and hold, especially if they've been holding it for 10 years. All right, I think I've